Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Carriage Services Inc. quarterly report. Carriage Services Inc. offers a wide range of funeral and cemetery services to the public. The company operates through two main segments: funeral home operations and cemetery operations. The funeral home operations segment provides various services including consultation, visitation and memorial services, transportation, removal and preparation of remains, cremation services, and related merchandise such as caskets and urns. This segment caters to individuals who have lost a loved one and require assistance with funeral arrangements. On the other hand, the cemetery operations segment offers interment rights for various types of grave sites, lawn crypts, mausoleum spaces, and niches. The company also sells related cemetery merchandise such as memorial markers, outer burial containers, and monuments. Additionally, this segment provides services like interments, inurnments, and installation of cemetery merchandise. Overall, Carriage Services, Inc. is a comprehensive provider of funeral and cemetery services, offering a range of products and services to help individuals navigate the grieving process and make necessary arrangements for their loved ones. Carriage Services, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Carriage Services, Inc. trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 2.53 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various internal and external factors. Revenue growth is primarily driven by an increase in cemetery receivables, trust management fees, income from perpetual care trusts, changes in the fair value of trust fund assets and liabilities, investment income, realized gains, sales of investments, acquisition of new funeral homes and cemeteries, pre-need sales, talent recruitment efforts, execution of strategic objectives, and investment performance. These factors collectively contribute to a significant increase in revenue. On the other hand, revenue decline is primarily driven by a decrease in divested revenue, funeral contract volume decrease, average revenue per funeral contract increase, pre-need insurance contracts sold increase, and pre-need sales production increase. Additionally, specific segments such as the funeral home segment experience a decrease in revenue due to a decline in contract volume. External factors also play a significant role in driving revenue decline, including a decrease in contract volume, an increase in operating expense relative to revenue, and a decline in ancillary revenue due to online cremation business decline. Net income and profit margins. A changing landscape, the net income of the company underwent significant fluctuations between 2025 and 2026. Initially, it decreased from $20,926 to $13,492, indicating a downward trend. However, in subsequent periods, it increased to $308,208 before decreasing again. The most notable decrease was observed in 2026, where net income dropped by $7,434,000, minus 35.5%, compared to the previous year. The profit margins also experienced changes during this period. Gross margin decreased from 36.4% in 2025 to 36.3% in 2026, while operating margin declined from 29.5% to 23.7%. However, adjusted operating profit margin showed an increase of 0.6% from 45% in 2025 to 45.6% in 2026. The reasons behind these changes are attributed to various factors. The net income decrease can be linked to the prior year's net gain on divestitures, impairment charges, and sale of real property. Additionally, profit margins were affected by increased general and administrative expenses and a decline in contract volume. These factors collectively contributed to the fluctuations observed in net income and profit margins during this period. The company's financial performance indicates a positive trend in its operating cash flow. The data shows that the net cash provided by operating activities has consistently been increasing over the years. In 2025, the company generated $13,792 in operating cash flow, which increased to $14,898 in 2026. This significant increase suggests that the company's operations are becoming more efficient and profitable, resulting in a substantial boost to its cash reserves. As a result, it can be concluded that the company is indeed generating positive operating cash flow, indicating a strong financial position. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, there is a consistent trend of decrease across various metrics. The long-term debt saw a 1% decrease from $528,335,000 to $522,281,000. Additionally, the total credit facility decreased by $6.2 million from $126.7 million to $120.5 million. The interest expenses have also shown a notable decline. Interest expenses decreased by 17% from $2,705 in 2025 to $2,240 in 2026. Furthermore, there was a decrease of $512,000 in interest expense from $2,499,000 to $1,987,000. The company's efforts to reduce its debt level and interest expenses are evident through these changes, indicating a positive financial trend. The financial performance of our company's operations varied significantly between 2025 and 2026. One area that struggled was funeral home operations, which saw a substantial decline in revenue of $1,581,000. This downturn is a cause for concern and warrants further investigation to identify the underlying causes. On the other hand, cemetery operations experienced a notable increase in revenue, rising by $1,788,000 compared to the previous year. This growth suggests that our cemetery operations are thriving and meeting the evolving needs of our customers. The disparity between these two segments highlights the importance of analyzing each operation separately to understand their unique strengths and weaknesses. Management is optimistic about the company's outlook, with funeral home operations expected to account for approximately 68% of total revenue. The cemetery operations are also seen as a significant contributor, generating revenue through sales of interment rights and related merchandise. However, management plans to sell certain disposal groups, indicating potential divestitures or restructuring efforts. In terms of strategy, the company is focused on creating capital growth, income generation, and risk-adjusted returns through alternative investments. This involves diversification and careful asset allocation to minimize long-term risk. Management also prioritizes capital allocation for strategic growth acquisitions, debt repayments, payment of dividends, and other general corporate purposes. The company's cash resources are expected to be sufficient to meet its needs, with existing and anticipated funds available for investment in strategic initiatives. Overall, management is confident in the company's ability to execute its growth strategy and achieve its objectives. The company's financial reports reveal a consistent trend of paying dividends to its shareholders. On multiple occasions, it is stated that the company has declared and paid dividends for both 2025 and 2026. The exact amounts are provided, with $1,772 being paid in 2026 and $1,722 in 2025. This information suggests a commitment to returning value to shareholders through dividend payments. However, there is no mention of share buybacks in the extracted summaries. It appears that the company's focus has been on distributing dividends rather than repurchasing its own shares. That concludes the financial summary for Carriage Services Inc. Feel free to comment below, and I will be happy to answer them when possible.